key thing that is missing in the reforms is the level of thought process that went into it. And I have actually said that, look, the way the reforms are being implemented is putting a lie to those of us who have been advocating for market-oriented policies. And I pick one particular instance because this conversation is basically for possibly decision makers to take back and see the modification they need to do. One of which is a fact that exchange rate has not been able to achieve some level of stability. Because for economic agents, it doesn't really matter what the rate is for many of them. What matters most is that there is some level of stability. Because if you have that level of instability, you create uncertainties. And because of those uncertainties, we are leading to loss of confidence or panic that has actually set in. I give empirical examples. When the exchange rate was harmonized, some of us had said, look, if we have enough supply, if you are supplying the market what you used to supply, that you maintained the parallel market at 750, you should actually see a reduction in a convergence below the parallel market rate. And the simple logic of it is this. The demand for Forex in the country is within a particular range. And previously, a large portion of that supply was going to a few entities. And those entities, some of them were not buying based on actual demand. They were buying for speculative purposes. So they round trip it back into the system and sell part of it in the parallel market. And we felt that if the central bank should supply the market, the volume that it was giving even to those entities that we are bringing back to make some spread, that we will achieve a convergence below the parallel market rate. But unfortunately, that didn't happen. Why did it not happen? Which is why I talked about the level of preparation that should have taken place ahead of the harmonization. A couple of things has happened. One, when you harmonize the exchange rate above the official window, investors, business entities who had dollar exposure and were in naira position had to lock in immediate exchange losses. And these exchange losses are non-notional, they are real. And if you take, for instance, assuming you are an airline operating a country and you have about maybe $300 million equivalent that you were bidding for to get from central bank at the remittance of ticket sales. And then all of a sudden, for each $1 million, you had provided about 460 million naira. So for each $1 million, the exchange had moved to 750 naira, for instance. That's for you use that for purpose of discussion. And all of a sudden, your $1 million now became something like $600,000. Your natural reaction as an economic agent is stop my loss. And what do you expect to do? You said, okay, look, I've lost my shit. You could be a portfolio investor in the country that's trying to remit your dividend or proceeds of sale of securities. She says, if I've lost my shit, so let me first exit. The first thing that happens when there is fire is that you run out of that fire environment. And then you want to know if the flame is still on. And the flame has calmed down, you can now go back and say, are there opportunities still left there? So, but unfortunately, there was no supply to meet the demands of those who had logged in significant losses. And if you are a decision maker elsewhere in the world, there's what we call stop loss. So at that point, you take in a loss and say, let me stop my loss at this point and exit. So this set of people will go back to the market, to the now I&E window, to try to get dollar for the nairas that are locked up. Unfortunately, there was still no liquidity for them to get out. So what was missing is that at the time of harmonization, there should have been an arrangement made in place. The first thing that the central bank would have estimated the amount of unmet demand had been with it for the past 9 months. Some of these are remittances of capital imported into the country that were previously invested in securities, local currency securities. Some of them were dividend remittances. Some of them were payment for airlines tickets. Some were payment for matured letters of credit. So, because there was not that arrangement, because if the arrangement had been made and said, we have an estimate of $20 billion, we have an estimate of $10 billion. And my approach is that there's what they call show of strength. So if we had some amount that we are supposed to clear those arrears, what would have happened? That the investors would have gone back and said, look, well, I lost my share, but maybe I went in at the wrong time. Today they harmonize the exchange rate. Today there's liquidity in the market. If you go in now, you're not going to lose money. So some of them will say, okay, I've lost money. I'm going to go back to that market and make back the money I lost. Because the market see bold opportunities. But unfortunately, when they couldn't get out, the next thing that will happen is that the panic sets in because they want to stop their loss. And they are ready to buy the FX at any rate. And they start bidding it up. And then you are seeing a continual depreciation in the local currency. And like we know, you have some psychological threshold. At a certain point, people begin to panic and say, let me lock in my loss, let me just get this money. And people begin to front load their demand. So when you have a situation where people begin to front load their demand, you have the currency can only go in one direction. So you have consistent losses. And the challenge with that, which is why I think for me it's critical that we address that, is that it now begins to affect a lot of other things. When Alex was presenting, he said, look, the impact of the Naira harmonization was going to have minimal in terms of on the inflation impact because actually, as he stated, local imported goods are priced based on the parallel market rate. But the problem is that when the parallel market rate begins to move up at an unexpected rate. So what we have seen is because panic had set in, investors are front-loading their demands. Anybody who had a future foreign currency obligation will want to go to the market and buy today and hedge against further depreciation. And that's why the impact of that is now transmitted into local prices. And the danger is that it's now beginning to reflect in the price of refined petroleum products. Because some of the shock absorbers, some of the that we had in the economy, yes, they were not economically beneficial, but they were shock absorbers in terms of the impact on the most vulnerable. When crude price goes up, an average Nigerian household does not know until now. Because the same exchange rate, the government absorbs it. It was a very expensive thing. He did mention that to us, which are fact, because when you look at the fact that from his report, our this year, earnings from crude will be about 8 trillion naira. And at the end of the day, we're going to have about just 3.5 trillion naira left after paying subsidy, after deductions about 4 trillion. So it was very expensive. But the least an average household wants to see is that there's some level of stability in price levels. So if you allow the currency to continue to depreciate the way it's going, it's going to be transmitted into general price levels because, like I said, prices, parallel market rate is what they use to bring in goods. But today we've seen a movement in the price, parallel market from about 750 to about 870. That is quite material. And that will reflect in average price of imported items. But the most important challenge is that it's going to be reflected on the price of transport costs. And an average household, if you look at the consumption pattern of average Nigerian household, it's basically food and transportation. Those two account for a large portion of our consumption. So for the most vulnerable, these account for about 80%, 90% of their consumption. So every society in the world tries to maintain stability in the price of transportation and the price of food items, particularly to the most vulnerable. And that's why if you go to Western countries, they have public transport systems whose prices are not repriced based on changes in consumer price index. So if you go to a place like England, the bus tickets are largely going to be constant for a long time. The train tickets are likely going to be constant for a long time. So even when prices have moved, the average household in England will only feel the price in energy cost. That is other energy elements like the fuel. But then, if you look at the poor people in England, they don't drive their vehicles around. They go by public transport. So, and that's what we need to address. We need to achieve exchange rate stability. And that my position is that the objectives that have been set out, which are quite commendable, could be challenged by a possible continued depreciation of the currency. Let's look at capital flow. An average investor anywhere in the world will want to see two critical things in the economy before they come in. One of which is foreign exchange liquidity, because they want to come in and go out. They don't want to get trapped. Second factor is exchange rate stability. If you have liquidity in your economy, foreign exchange liquidity, investor comes and, okay, I've made a profit, I want to go. I've taken a loss, I want to stop my loss. Every portfolio investor has what we call stop-loss policy. Beyond a particular threshold of losses, they say, sell and come out. So when they sell and they can't come out, they won't come to that market. So we need to address that. The other one is the issue of price stability. The investors that are coming to your local economy are hunting for return. Because they are investing in local currency assets, there is a conversion or exchange rate risk associated with every investment they make. So, if, for instance, you come to a market and there is a return yesterday, TB's rate, stop rate was about 12%. So, if you come to the market and make 12% and say, look, I'm going to go to the primary market, bid for treasury bills in Nigeria, make 12%, sell in fact, yesterday at the close of trade, it was trading at 9%. So if you are actually coming to the market, you could make that capital gain within a day. But the question becomes, when you want to convert back that investment dollar you brought in back to your dollar, and Naira has shifted by 15%. Though you have made 12% return in a year, you've lost effectively 3% of your capital. And investors will not come if you don't have that stability in exchange rate. It doesn't have to be a fixed rate. It just cannot shift by more than 5-7% in a year. Unless there are drastic crises where you need to do that shift. But it cannot be something that is oscillating on a daily basis. So these are factors that I felt would have taken into cognizance. What would we have done? Probably the fiscal and monetary authority will work together to identify, if you call it a budget support facility from a multilateral agency or a bilateral partner. And that would have been used to deal with those areas and create an illusion of capacity to meet. It's all about confidence in a currency. The confidence you have in a currency does not necessarily mean they have 100 billion of reserve. It simply means that you feel that anytime you want to convert back to your currency, you can do that. So if we had achieved that, which unfortunately we may have missed, if we had achieved that, probably what we'll be witnessing today is that investors who have future demand will be waiting and hoping that currency will appreciate. And this becomes self-fulfilling prophecy. Once you have that confidence in your currency, people will not make demands that they don't have need for. So if they don't make demands they don't have need for, those who want to sell will not have enough demand for the foreign currency. And they will be price takers. So market power moves in the direction of those who want to buy. Because those who want to sell are saying, look, prices are coming down, so let me sell now. Those who want to buy are saying, price is going down, let me hold back. And then you see Despite not having seen the structure of the fundamental structure of the economy, but because of that confidence, you see prices moderate. And I think we got it wrong in that aspect. Just before I round up, because I don't think I have so much time, but I think there's still going to be a panel session. Another thing I want to mention, which is, it draws from what Alex presented, that we are in a situation where you have low revenue, low expenditure. And how do we come out of that situation? My take is that it's like a bind where you need to break out of it because you need the revenues to invest in the capital goods that will generate additional revenue. So if you don't have the revenue, how do you invest? And today, even with the reforms, from what he said, our ways and means borrowing is still going to remain quite high. We're going to still end up with a budget deficit of about 8.9% of the GDP. This year, he said it's going to be about 12% of the GDP. So how do we break that cycle? My take is that for Nigeria to break that cycle, we need to identify sectors of the economy that will have competitive advantage and come up with specific policies, sector-based policies that will attract foreign capital. So we need an injection of foreign capital, not foreign portfolio investment. And it has to come with a well-thought-out strategic plan to incentivize investors in some sectors of the economy. We've done that successfully in the telecommunications sector. Telecom sector has now become the second largest contributor to the GDP of this country. It used to be an infinitesimal segment of the GDP. And what did we do? We came up with an appropriate fiscal policy that came up with a legal framework, commercial framework, and allowed private sector investors to invest in the Nigerian telecommunication sector. We still have sectors that have that potential. Power sector. We've tried to do reforms which we got wrong. Key infrastructure sector. There's no reason why today we still don't have a commercial operated highway. We tried to do that in Lekki. It was probably wrongly done. There's no reason why you shouldn't have an overpass that runs from here up to VI, but it's tolled. If you enter that toll, at every point you pay 1,000 naira. Maybe 5,000 naira to VI. You know what will happen? You said, look, why would I be in traffic for the next 2 hours to get to VI? When if I take this overpass and I tear off straight to VI, if it costs me 5,000 naira. A lot of people who have their vehicles here will do that. So there's still a lot of commercial opportunities. There's no reason why we shouldn't have deep sea ports that are funded by private sector investors. I'm just mentioning but a few. That if the government comes up with specific policies that are well developed, that will attract private capital, that's the only way we break that cycle. That poverty cycle, poor revenue, poor expenditure. Because I've always said this. Today we've gotten to the point, if you look at the fiscal cliff we talked about, that this country cannot fund infrastructure from budgetary allocation. It won't happen in the next 30 years. So the more we try to do that, every kobo that is invested in infrastructure today in Nigeria is borrowed. His report said we are currently spending more than 100% of our total revenue on debt service. So what that means is that even the government overhead is borrowed. So why would government continue to borrow for infrastructure when government is not known as having the capacity for value for money when it comes to investment? Why would government borrow and do a road that the private sector would borrow and do at a cheaper cost and at a more timely delivery? And then we are happy to say the government has done the road. And they will do it so poorly. Embedded in it are a lot of toll gates. I mean, when I mean by toll gates, I'm talking of corruption embedded in it. So exactly what you get. Because we don't realize that it's our collective wealth that is badly spent in that way. The burden of that debt payment is on us. So if the private sector can build it and toll it, and we still get the same infrastructure, which will catalyze economic development. and then without a burden of debt payment in future. That would be better for us.